All right, everybody. Well, we are going to go ahead and get started. Welcome to today's webinar on building tax-free wealth with your self-directed retirement account. So we have a lot to cover, and for the sake of today's discussion, obviously we're joining via webinar here, as we mostly do webinars even prior to COVID, but certainly in a COVID environment, we're broadcasting all of our educational content through the web. So thank you for taking the time to join us today. I'll be leading us through the discussion today. My name is Jason DeBono. I'm the Vice President here at Newview Trust Company. And over the last 15 years, I've got to see and do a lot of things in the self-directed IRA space. And so I'm going to share a lot of those with you today. I do encourage questions throughout the process. You should have a chat function on your screen there. If you'll just type that in, I will pause every now and then, grab the mouse here, and take a look at some of those questions. So I would encourage you to ask those, and again, I will get to those as we go through everything today. So, you know, obviously we'll maybe start with kind of where we all are in the world, and regardless of kind of where you stand from an opinion standpoint, the thing we can all agree is that the world has changed. And as the world changes, our investment model and philosophy has to change right alongside it. And so what we've seen is a lot of different behaviors. We've seen some people that have quickly moved into stocks because they think there's opportunity, and we've seen an equal number of people that have quickly moved out of stocks, right? And it doesn't make either of those groups right. Time will tell in the long run, depending on when they bought and when they ultimately sell. But what we talk about here at Newview is really about the broadest level of choice. And if that choice does include stocks, great. If that doesn't include stocks, even better. So we're going to walk through that, the world today in general terms. Obviously, some things are maybe a little bit different, and you may have a different outlook on those. And again, that's the beauty of self-direction. I will start with just a personal story and tell you that I am the world's worst stock investor. I sold Amazon, Apple, and Netflix in the middle of March. Now, for those of you that have been following the market, you know that I believe it was March 19th. If you look at that little chart, you just see that big dip. Right about at the bottom of that is when I've sold. And since then, all three have gone on and continue to soar. And as much as I want to say to myself, you know, beat myself up, I realize that's okay. I don't have the risk. I don't have to worry. I don't have to look at the numbers. And when I compare those investments, right, and I did thankfully exit them with profit, so I made money on them, right? I sold them when I lost a lot, and if I'd have held them, I could have made a lot. But at the end of the day, it was still a profitable investment, right? And I'm thankful for that. But what I don't have to do is guess anymore. And if I compare that to all the private note investments, real estate, private bank, oil and gas, any other investment over a long, long period, those stocks have been the thing that I have always questioned the most about their ability to go up and go down. I turn on the news, I look at the Yahoo Finance page, it says, breaking news, 20 million people unemployed in 1 month, and the market's up 3%, right? It doesn't make logical sense. And so what we're going to talk about today, I want you to keep that in mind. Maybe you're smarter than me, maybe you understand the market, maybe you know why stocks go up and stocks go down. I don't. So for me, it's a place to diversify in small amounts, but the bulk of the investable assets that I have and put to work are all in alternative assets. And the number one reason for that is I know and understand them. Doesn't mean I'm guaranteed to make, you know, great investments. I've lost money on investments outside the stock market, but it's the only area that I've ever found that I can, if it goes up, I can understand why. If it goes down, I can understand why. And I'll talk a little bit today about some of the things you should be considering in this process as well. So my job today is not to tell you to sell every stock you have and move it. Again, I'm the last person to take buy and sell advice on stocks and bonds. However, over 15 years, I've been fortunate to make lots of very good investments through very good strategies, all in alternative assets, and generated well above average returns while limiting my downside all through self-directed accounts, and that's what we're going to share today. So ask as many questions as you want. I think hopefully I've eliminated any stock picking questions that may have been coming through, but the goal today is just to open your eyes to kind of the process and understanding of how alternative assets are held in retirement accounts. What does it really mean, and why should you consider doing this with some or all of your portfolio? And I'll wrap up with, as we look forward, right, the landscape of the world is changing, and your investment strategies and philosophies should be changing too, regardless of what anyone in the marketplace tells you. There will be opportunity at some point, if not already today, in a variety of asset classes. So as we go through this today, I want to start by telling you, I've already told you I'm a terrible stock picker, but I also want to tell you I'm not an investment advisor, CPA, attorney, accountant. I'm not here to tell you, what you should do. I'm here to tell you what you can do. Every account that NewView custodies is self-directed. Self-directed means you get to choose, not me, not anyone on our team here. So we're here to help you understand the how and the why and what you can do, but the ultimate decisions on your investments and the legalities and making sure you stay within the rules, etc., are all part of the self and self-direction. So please don't rely on us for more than we're capable of providing. So who is NewView Trust? Well, NewView Trust NewView Trust Company is a custodian for self-directed accounts. That means we provide the service of record-keeping, reporting to the IRS, and reporting to you on an annual basis. What we don't do is tell you what to buy. We don't endorse or approve your investments, but we do buy on your behalf, hold those assets, sell on your behalf, and do all the reporting in between those periods to the IRS. It's no different than what Schwab does for your IRA today, but they're providing custody for stocks and bonds. We're providing custody for things like real estate, private notes, and other investments. We've been in the business 17 years. We've got nearly 50 team members here that work their tails off to make sure that you and your account are well taken care of. We're just under $1.5 billion. So, again, 15 years ago, if you'd have told me, that we'd be holding $1.5 billion of assets of alternatives, I'd be shocked. Looking today, we continue to grow, and we grow because people are constantly looking for ways to invest in something that they believe that they have more control over. And that's really the biggest reason most people are leaving stocks and bonds and moving into these alternative asset classes that we're going to talk about today. And as a company, we want to be simple, accessible, and relationship driven. So we want you to ask us all the questions you need. We want you to feel comfortable in the process with making investments, but we also want to make sure that you have done your own due diligence to make sure that this is a good investment for you, right? Investing is certainly personal. All right, so, and actually I can skip this slide together. I want to start with the first slide about people don't save. Now, I know obviously as we go into a time with heightened unemployment and all of that, I'm probably telling the right message at the wrong time, right? Which is people's income is going down and I'm telling them to save more. I get it, right? This may not be the best message today, but the message still rings true, and that is saving is equally as important as investing. And so many places stand up every day and tell you, invest, 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 invest. And yes, we're going to beat that drum today. But I want to make sure you understand saving is important too. And I'll give you a very simple example. If I save $5,000 and someone else saves $50,000 and we both make the same investment at a 10% return, my $5,000 makes me $500, their $50,000 makes them $5,000, right? Same investment, different saver. So you can win this game on both ends, all right? So when it comes to saving, it is important. You can see from the slide on your screen, the vast majority of people aren't saving. I think this is common knowledge. It's unfortunate, but it's reality. So if you want to follow the herd, continue to not save. If you want to give yourself the best opportunity at retirement success, save a little bit more. And I can tell you, when I started here, the best advice I got from Glenn, who started this company, was save till it hurts. And every time you get a pay raise, increase the amount that you save. And I have followed that logic, and I've been able to build what I believe is a very sizable retirement account, right? Certainly by most standards, by saving more. And what I've learned is that when I don't have the money to spend, I don't spend it, right? And so it's very, I won't say it's easy, but it's very simple, at least philosophically. So I give you guys that information, save, save, save. You realize here that the numbers don't bode well for you if you follow the status quo. And this is a trend we have to get past. And the more and more that we look at what's going on in the world today, we are continuing to take on debt as a country. And that's just reality, regardless of your opinion on it. But at some point, that debt will catch up with us, or it may catch up with our kids or grandkids. And so some of these programs that we think will get us into retirement and things like Social Security, right, they're all at risk the more debt we take on as a company or as a country. So, make sure that you're not relying on the government exclusively, right? It can be a nice addition to your savings, but self-direction is about taking control and making the necessary moves to put yourself in the best position for retirement. Saving is a big element of that. The other thing that we need to be aware of is commissions. Make no mistake, we charge fees, right? We are not a nonprofit company, right? We are for profit and we charge fees to operate our business, but our fees are transparent, meaning we tell you what we charge. Unfortunately, in a lot of public securities, fees are not transparent. There's lots of things in mutual funds and commissions and other things that are clipping away and clipping away and clipping away. And so I'm not telling you to be so fee-centric that you make bad decisions. People deserve to be paid, right? And they deserve to be paid a fair price. But I'm a believer that you deserve to understand what those fees are. And if you think that you're not paying fees in your Fidelity account because they no longer charge commissions, I would suggest that you go and look and see if Fidelity is a profitable company. Last time I checked, they're immensely profitable. It's not because of commissions anymore. It's because they found ways to get fees on all the mutual fund and other investments that they, are putting out in the marketplace. So again, I'm not saying their business is bad. I'm just saying to be mindful of it. As many investors we've had have said, well, if I open an account with you, I got to pay fees, but my Fidelity account is free. Right? There's no such thing as free. They make a lot more money than we do. We'll tell you what we charge. We charge a fair price. We provide a fair service, but we don't have any of these average, expense mutual fund ratios, et cetera. What you make on your investments is yours to keep. You pay us activity fees for the behavior beyond that. We're playing a game we can't influence the outcome of. So this was right before COVID, and I'm in Florida, and at least here, we had a stay-at-home order for the entire month of April, and it wasn't until Monday of this week that they allowed barbers and salons to reopen. Thankfully, I got my hair cut like 2 or 3 days prior to the end, and it was just after that big dip on March 19th in the market. And the individual that I went in was cutting my hair, and he said, man, what do you think about the stock market? And I said, well, first of all, I'm not qualified to answer, any differently than anyone that sits in your chair, but I'm happy to share my opinion. And I likened it to gambling, right? And specifically blackjack, right? Now, I like blackjack. I don't know about you guys, but it works the same way. And if you think about the logic of gambling, you cannot control the outcome. And I want to make it perfectly clear in the stock market, you have zero control over the outcome. But here's what happens. You sit down with $100, 1,000, a million, it doesn't matter. That $100 grows to $150. You now think you are entitled to $150, right? You bought a stock for $100, it went up to $150. The world is great. That drops a little bit, and you don't typically think, I started with 100, I'm down to 120, I'm actually up 20%, all is well. You focus on the fact that you lost $30, $30, and so you start thinking you're down 30%. So that's one major issue. Number two, what do most people do at the blackjack table when they're down? Do they bet bigger or smaller, right? They start betting bigger. I'll just buy my way out of this, and I'll just invest more. Well, if you don't control the outcome, you're no more likely if you put money on the table, right, to earn than if you didn't. Then what happens is what we've experienced, right? FOMO, the fear of missing out, right? This is a scary one. So what happens is we put in 100, it went to 130, and it drops to 75 or to 65. And what do? We go, well, now I've already lost enough. Now I've got to ride this out. And I keep thinking to myself, why is that a logical approach? I have $75 or $65 today. If I sell it, I can put that into something else. If I don't sell it, I'm at the mercy of that particular investment. So what do? They don't want to sell because they feel like they've lost too much and then now they can't take the realization, so then they stay in longer. Maybe they get their money back, maybe they lose, but it's a vicious cycle because once they get their money back to 100, they don't sell and walk away from the table. They think, well, I used to have 130, so I'm going to go to 130, and guess what? When you get to 130, you won't be satisfied. You want to get to 150, and it's a fool's game, right? The difference is in gambling, you know that, and we're talking about a few $100. And what happens to gamblers, right? They cash in their chips and they never walk away. What do? They just stand behind the table and they watch. And then the very first thing that comes out is a blackjack for the person that took their seat or the person next to them, and they think, oh, I should have never left. It's illogical. But it's gambling, and people accept it. Yet in the marketplace, we don't call it gambling when it works the same way, right? People have FOMO. They don't want to miss out. Well, what are you really missing out on? And they say you can't time the market. Don't sell. You'll never time the market, right? Well, guess what? How do I time the market eventually? Because at some point, I got to sell. Am I supposed to stay in it forever? It's something that, again, I'm not trashing the stock market because I do think there's opportunity there, and I get it. But if you really go and look at what the logic is behind things going up and going down, there's none. There's very, very little. So at a time where we've got this major headwind of economic stopping, not slowdown, stopping, stocks are rising. It's a game that you're playing that you don't control the outcome. And when you don't control the outcome, you basically have to hope that you are lucky on the buy side and lucky on the sell side. And in my world, from an investment standpoint, I like to gamble. I don't mind, having a little bit of luck on my side, but that's not where my portfolio goes. That's where a small piece of it goes. And if I win, great. If I lose, great. Just like when I sit down at a blackjack table, if I win, great. If I lose, great. But I don't view my investable dollars that way because that's different, right? If I gamble at a blackjack table, it may influence where I have dinner that night, right? If I gamble with my retirement money, it may influence whether or not I got to keep working into my elder years. That's a much different gamble, right? One I'm willing to take the risk on, the other I'm absolutely not. So I ask you all on this call today to challenge yourself. Are you me at the blackjack table? Are you really investing your money? Or are you simply listening to what the crowd says, which is put the money in, let it sit there long enough, you'll make your money, right? I would question that. And if you feel like you're that person that is treating it like gambling, then it may not be the right asset class for you either. So what does that mean? So let's talk a little bit about investments, right? I guess let me pause there and let me see what we're doing, how we're doing for questions here. I don't see anything that's come in yet, so if you do have them, please ask them. So I want to share one last slide with you before we talk about the meat and potatoes of self-direction. And that is something that I came across a few years back from a numeric standpoint, and I felt like it illustrated the perfect picture. Now, I can't speak to an exact percentage, but I'd be willing to bet probably 60 to 75% of our clients that buy investments through their self-directed account currently have or do have investments of the same type outside their account, right? So meaning a lot of times people are buying real estate with their personal money, but buying stocks and bonds with their IRA. And a lot of times it's because they don't know, right, that they can buy real estate in their IRA. But other times it's because they don't understand the value of buying it in their IRA. So I'm going to share something here about saving and investing because remember, it's a two-part game, right? You got to be a good saver and a good investor. But I'm going to add a third part to the game, and that is you got to save in the right vehicle. So I'm going to start by just illustrating if I were to take $1 and double it 20 times, right? Now, I gave you the number there. If I take $1, it becomes $2. Actually, let me go back. $1 becomes $2, $2 becomes 4, 4 becomes 8, 8 becomes 16, 16, 32. You get the idea all the way down 20 times. Now, I guess I teased you with the number. That $72,000 is a big number. But keep in mind that this is based on a 25% tax. So if you notice at the very top, that dollar became $2, which became $1.75. Dollar of profit, 25% tax, right? So I was left with $175 to reinvest. I reinvest $1.75. I make $1.75. I pay tax on $1.75 at 25%. I'm left with $3.06. $3.06 doubles, becomes $6.06. I pay 25% tax, and I'm left with $9.38. You get the idea. When it's all said and done, it's pretty good. I'll have $72,570.64, right? What I want to illustrate for you is how much taxes impact your overall long-term investments. Because in an IRA, we're talking about long-term. So if I said to you, I can eliminate the 25%. So you want to buy real estate, you want to buy whatever it is, I can eliminate the 25%, which is exactly what a self-directed IRA can do for you. So $1 does become $2. $2 does become $4. $4 becomes $8. And if you start to look, right, the numbers start to get bigger and bigger and bigger and bigger. So I'll show you the number, but I'll ask the question in digital format first, right, to just challenge yourself. How much money do you think that really cost you? So the way that you get to that is if you eliminate it, right, how much money would you have? And the difference is unbelievable. It is $1,048,000. And you can go test my math if you really want, but now compare that. So I just want to paint a picture for you. Same saver, right? I saved $1. Same investor, I doubled my money every year, and I understand that's not realistic, but for illustration purposes, right? Same investor, saver, same investor. But the difference is this person made their investments through their personal account only, and this person made their investments through their self-directed account. Remember, same investments. And this person has $72,000 to show for it, and this person has $1,048,000 to show for it. And what's awesome in an IRA, I can either choose the Roth account and pay the tax on $1, and that number is truly tax-free to me, or I can choose to save the taxes and get a deduction on the $1, and then I'll pay tax on $1 million. Even at 30%, I'm left with $700,000, 10 times more than if I was paying 25% along the way. If your tax rate is higher, 30, 35%, this number dwindles quickly. But because this is not taxed annually, it's taxed at the beginning or the end, which is your choice, by the way, the number is significantly more. So I share this because it's the only way to really help illustrate the value of a self-directed account. Now, you can use stocks and bonds and mutual funds as the asset class to get you here, right? But what alternative assets do is give you the more consistent, knowledge-based, control-based investments that will hopefully get you closer to this number and further away from this number. So what are the types of accounts? Well, first of all, when it comes to the types of accounts you choose to self-direct, it is not a one-size-fits-all. You can have multiple accounts. There are some limitations if you choose certain accounts where you can't double dip, but for the most part, these 4 accounts, traditional, Roth, SEP, and simple, you can have one of those as well as an HSA without having to worry about income limits, as well as having an educational savings account. So the types of accounts that we hold, traditional Roth, right, smaller contribution limits, one's pre-tax, meaning you pay the tax at the end and get a deduction up front. The Roth is post-tax. It means you pay the tax on the $1 and not on the million. Pay on the seed, not the crop. The choice is yours. I encourage everybody to look at the Roth first. If it's too expensive, go traditional, but start with the Roth because there's no other way that the IRS gives you the ability to prepay your taxes, right? And in a lot of cases, if you're a decent investor, that's going to come out significantly ahead, again, if you're a decent investor. SEPs are for people that are self-employed, higher contribution limit. Simples are for small businesses. So, typically 10 to 100 employees. It's a way to offer a 401k life plan that falls under the IRA, so a little bit less costly, a lot less paperwork involved. But the simple IRA, if you're a small business owner with employees, may be a good tool for you. Health savings account. For those of you that have high deductible health insurance, you would qualify for a way to save. The beauty of the health savings account is it's the only account on here that is tax deductible on the way in and tax free on the way out for qualifying medical expenses. Every other account is either taxed on the way in or the way out. In this case, the HSA is giving you a tax deduction and tax-free growth. It's the best plan on here if you qualify, candidly, right? Because if I had to choose, should I max out my traditional IRA or my HSA, I'm maxing out my HSA first, assuming I qualify. All day, every day, because it gives me tax-free growth. If I don't use it all for medical expenses, I can take it out and pay tax on the gain just like a traditional. So I might as well, get the benefit up front. The educational savings account, for those of you with kids, grandkids, nieces, nephews, or if you have none of those but you feel, generous, I've got 2 kids, I'm happy to give you their information if you want to make contributions for them. An educational savings account allows people to save for a minor's education. The beauty of this, unlike a 529 state-sponsored plan, is this account can be self-directed. So if you put money into this account every year and you want to go buy real estate with it, you can, just like in an HSA or any other account on here. So it's a way to maximize tax benefits while not giving up your investment philosophy. So we see a lot of people that say, well, I don't really put money into a retirement account because real estate's my retirement account. And I tell them, real estate's an asset class. You're buying it personally, why not put the money into an IRA and buy the same real estate? It's still the asset that's going to get you to retirement, but when I go back to this slide, it's going to put you in this camp instead of this camp, right? So I'm not telling you to change the way you invest. I'm telling you to understand that it can be done in an IRA, and the advantages are significant from a tax standpoint. Individual 401k or solo 401k, owner-only 401k, it goes by a lot of different names. This is a plan that if you have self-employed income with no employees, stop what you're doing and call our team about setting this plan up. Even if all you plan to do is just buy stocks, there is no better savings vehicle that exists for anyone than the solo 401k because it is the easiest plan to operate, but you have to be self-employed with no employees to qualify as a general rule. So if you have income that you take through self-employment and you got no employees, like I said, drop what you're doing when this class is over and talk to our team about it because it is as good as it gets. This plan can be fully self-directed as well, and because it's a 401k, you can be the trustee, meaning you can have checkbook authority on that plan, not by setting up an LLC or some additional structure, but simply automatically granted. In an IRA, whether it's Schwab or NewView, the signatory is the custodian by nature. Here, the signatory and the individual is automatically you as the owner of the business. So certainly something to be considering. We do separate classes on that. That plan is awesome, and I would encourage you to take a strong look at that. Let me get some water. Let's see if we've gotten any questions that have come in. So I don't know if I'm covering, everything. Let's see here. There we go. So for those of you that are asking them through the chat, there is a way. I think you have the Q&A, but either way works. So let me pause here. I've got a couple. So the first one says, do you help with LLC and corporations as well as self-directed accounts? Can you maintain your stock investments with you and make your alternative purchases, or do you have to divest and start fresh? So first of all, thank you for all the questions, but that's a great question to ask. As I mentioned at the beginning, we're not accountants, attorneys, so we do not structure entities. So that we have a list of people that we know that can help. Specifically, if you're looking to set up an entity within an IRA, which is possible. But that, as far as setting up incorporation and other things, that's something you'd want to talk to your own tax or legal counsel on. As far as maintaining stock investments through us, yes, we can hold securities. So there's 2 ways to handle that. Most clients of ours will only bring over what they want to invest into alternatives. So they will, in fact, liquidate a portion or all, depending on how much, and move it to us for real estate or note purchasing. The other way is to move the money to us, and while you're here, if you do want to buy stocks, we have an institutional relationship with TD Ameritrade. So we do have a way for you as a client of NewView to utilize TD's self-directed platform within your NewView account, where you can keep your stock portfolio and your retirement assets that may be outside of stocks all under one roof, right? We can talk more about that with any of our sales folks if you have some questions, but that is an option. Can you have more than one HSA? I have one through my company. If I open a self-directed IRA, can I allocate funds to a second HSA? So the answer to that great question is yes, you can have multiple HSAs or IRAs or any of these accounts. Your contribution limit is the aggregate. So if you set up an HSA and it's a single plan and the limit is $3,500 and your company points you to HSA Bank, right? You could choose to open an account at NewView and have a second HSA. What you cannot do is put $3,500 into HSA Bank and $3,500 into NewView. That limit is as an aggregate, so you could put 2 into HSA and $1,500 into the HSA at NewView or all of it. So yes, you can in fact set up secondary accounts. What a lot of our clients do that have company-sponsored HSAs is they'll keep the HSA at the firm where their company directs their money. A lot of times the company's even adding some money to that, which is awesome. And then they'll just go in and periodically request the amount they want to move into self-direction and transfer it from the current HSA at, again, HSA Bank or whomever, into their NewView account. And they may do all of it, just a part of it. They may do that regularly. That way their continued contributions keep going into the plan through the company. So both of those are options, and our team can walk you through that specifically. Let's see, it says contributions must be made with earned income for these accounts, but not with the HSA. Yes. I don't know the answer to that, and I guess I'm embarrassed to say that, but that's okay. I don't know everything, I suppose. HSA contributions, my understanding was there does have to be earned income for that, but I do have your information, and I will get you an answer to that, and we will send you a note or call you specifically with that answer. But thank you for asking that, and thank you for stumping me. A couple other questions. It looks like a second question by the same person. What criteria should I use to compare custodians? So great question. When you compare alternative asset custodians, and I'll assume that you're talking about custodians that do what we do, not including the Schwabs and Fidelities of the world. So a couple of things. The first thing is accessibility, right? Pick up the phone and call them a couple times, right? How long does it take to get someone on the telephone? Because that's what your life will be like as a client. And if they're quick to answer the phones, if they give you the answers that you're looking for, then at least they get on the short list. If they put you on hold for 30 minutes or you can't get to anyone, or you may want to just cross them off your list, because accessibility in an account, if you want to go out and make a quick investment, one of the biggest complaints that we hear in the marketplace is, well, I tried self-directing, but I lost the deal because I couldn't get a hold of my custodian, or they couldn't move the money fast enough. So make sure that you start there. The second thing is strength and stability. How long have they been in business, and how many assets do they hold? What's their breadth of experience? There's a lot of companies that pop up in this business, but they don't have much experience. So not to say you have to be in the business for 100 years to be good, but yeah, I mean, I would say if you have a choice of a custodian that's been in business for 10 plus years versus someone that's been in business for 6 months or a year. The third thing is fees. Fees are not the only thing that matter, but how do they charge them, right? What are they? Is it clear what I'm paying? Am I paying for services I'm not using, right? Like, am I paying one fee, or am I paying a fee every time I do something? There's no wrong way to choose, but you need to understand what matches your philosophy. So I think you kind of take all of those things. The last part is regulatory. How are they regulated, right? Who are they regulated by? Because there are companies like NewView that is a trust company. We are fully regulated. Our trust and compliance office is in South Dakota. We are a South Dakota public trust company. We are regulated by South Dakota Division of Banking and examined through them. That should give you a lot of confidence, right? There are companies in our business that they basically utilize third-party services for compliance. So I would want to know that. Do you have your own compliance personnel? Where are they located? Who audits you? Are they auditing the compliance group and kind of auditing you, or are they auditing you directly? So you can look at all of those things, but it starts with accessibility. I wouldn't do business with anyone that I couldn't get on the phone, and I wouldn't do anyone that wasn't responsive to my needs, because that's likely what you're going to deal with on an ongoing basis. As far as Do we have HSAs at NewView? Yes, we have all of the accounts that you see here, and all of them work the same and are fully self-directed. And then the last question there, we'll get back to it, said, the numbers here are contributions. Does that have impact on a rollover? Great question. What you see here on the screen is only a limit on annual contributions. That's you taking money out of your personal account and adding it to any one of these accounts. These are the limits. If the money's already in one of these accounts and you simply want to transfer it or roll it over from another institution, there is no limit. So if you got $100 million sitting in an IRA at Fidelity, you can transfer that to NewView. You're not going to be bound to that. Same thing with income. So if you make an investment and you make $100,000 on it, don't worry, it all goes back to the IRA tax-free. It's not subject to this either. The only limits on IRAs has to do with you adding money to them on an annual basis. So thank you for that question as well. Continue to ask those. I will keep breaking and taking some of those. I prefer it to be interactive, and I appreciate the questions thus far. So as we talk about plan types, just keep in mind that your ability to have any one of these accounts or a combination of these is possible. And I hear all too often that people say, like, well, I only have a traditional because I can only have one. Just keep in mind you can have multiple accounts, and you can invest them alongside each other. And we're going to talk about that here as we go through a couple of examples of purchases. So our team here is happy to kind of walk you through what the qualifications are and whether or not you could have a traditional and an HSA and an ESA, which is really, really cool. All right. So as we go through, and let me get back. And now we kind of shift away and just take that mindset, and don't forget that we talked about being a good saver and saving in the right vehicle, right? The more you save, the more you have, the more you have, the more you invest, the more you invest, the more you make, right? Starts with saving. Second thing is the type of account. The right type of account can allow you to save more because you can find different accounts, but the tax advantage benefits of these accounts allows you to keep more of what you make. So save more. Save it in the right vehicle, step one. Step two. Step three, invest it in what you know and understand. So what are the things that our clients do and you can do with an account at NewView, right? Real estate, private stock, partnerships, tax liens, LLCs, precious metals, mortgages, notes. The list goes on and on. In fact, it's pretty endless in terms of what you can buy, and we'll talk about that in here in just a second. So self-direction says, what do you think is the best way for you to make money? Here's a tool to go do it. So why are you hearing this? Well, because Schwab and Fidelity and most advisors, they don't work in this business. They don't have alternatives, and they haven't monetized the business. It's just like why when you go to Taco Bell, they don't tell you where to go get a burger. And when you go to McDonald's, they don't tell you if you want a taco to go to Taco Bell, right? That's their business, and that's okay. So you have to find someone that's specialized in this field, which is exactly where we come in. So what are the rules? Let's start there. The good news in all of this is the rules are very simple. The rules basically say what you can't do. And I mentioned I have two kids, and I kind of refer to this as the toddler rule, right? For those of you that have kids, grandkids, or borrow someone if you need to really understand, rule, and you can borrow mine if you need. But the toddler rule basically says, how do you parent toddlers? You don't walk around and tell them you can do this and you can do that, right? What do? Don't do that, don't eat that, don't touch that, don't climb on that, right? It's the don't rule, and our logic is if we tell them what not to do, they'll understand that everything else is okay. The IRS, right, thankfully only has a few rules. On the other side, maybe they're treating us a little bit like toddlers, which probably is fair. The rules are simple. Here's what you can't do. Rule number one, you can't buy life insurance or collectibles, works of art, metal or gems, stamps or coins, right, rugs, alcoholic beverages. They define all of that as not being permissible. And the logic is there. Your IRA can't buy life insurance because they don't want you to own assets that benefit your heirs when you die. They want you to use your retirement plan to buy assets that benefit you when you retire. That's the whole point of the tax benefits. As far as collectibles, right, antiques, metals and gems, stamps, coins, artwork, the reason they don't allow that is because they have no real way to monitor value. So they can't forecast future taxes, nor can they review your activity to see if you paid fair taxes. So if you think about this, if you owned a piece of art and you withdrew it from your IRA and it was a pre-tax account, so you owed tax on the value at withdrawal, are you going to declare that piece of art worth $1 million or worth 50 grand? Well, how would the IRS be able to know? Yet if you withdraw property from an IRA, the IRS can come back 2 years, 3 years, 5 years from now and look and know that if it was in this neighborhood and the average price per foot sold in that area was $150, they can get a rough idea that, yeah, this taxpayer paid a fair rate, right? So if you withdrew that house for 50 grand and every other house in the neighborhood was selling for 500 grand, the IRS is going to be able to mount a defense, right? So they want to make sure that they can police it. So they said, no buying stuff for your kiddos, right? Buy something for you that generates you return that you can actually capitalize on while you're alive. And then they say, no buying any kind of assets that we can't really come back and police. And if you look at all the other asset classes, notes, real estate, private businesses, there are generally accepted principles on how you value them. But with artwork, it's so subjective. And the IRS says, we're not going to play that game. There's too much tax opportunity here. We'll just say no. So they're not saying you can't buy artwork. They're just saying you can't buy it in a tax-advantaged account. Rule number 2 says, if you know what you can't buy, right, everything else is fair game. So rule number 2 doesn't address what you buy. It addresses who you buy it from. And the IRS says, if we have this tax-advantaged account, we know that taxpayers are very, very, very into tax avoidance, rightfully so. We want to pay as little tax as possible. And the IRS says, like any tax shelter that they create, and there's lots of them, they have to fence off behaviors that they think will cross the line too easily. So the IRS says, you know what? If somebody has an IRA, right, we can't let them buy something from themselves through that IRA, because they could easily sell it at a discount or a premium, right? And it'd be really hard for us to monitor that. So they say, you know what? The people that we don't want your IRA doing business with include you, your parents and grandparents, your children and grandchildren, and the spouses and businesses of any of those parties. So if you can't do business with dad, you can't do business with dad's LLC, right? So if you can't do business with yourself, you can't do business with your spouse. You can't do business with your son, you can't do business with your son's spouse, right? So you have to be very careful. The rules are simple, and for some people, they can't get past them. They're too worried about buying their son a college, a condo for them to live in while they go to school. And the IRS is not saying you can't do that. They're just saying they don't want you doing it in a tax-advantaged account because you're buying that condo for your son, not for your IRA, right? So if your intention is to use this money in a personal capacity, if your intention is to try to funnel money in or out, we're probably not the right company for you. The rules don't allow it, and we're not the police, the judge, and jury, but we also don't bury our head in the sand. Our job is to give our clients full control, and we love what we do, and we're passionate about what we do, but we do expect clients to follow the rules, right? And the rules are simple. Buy your investments from unrelated people, rent, sell to, lease to, etc. from unrelated people, and you'll be just fine. Self-direction is a great tool. So one of the things that we talk about is buying investments on sale. And, this is an interesting one because I heard people say, well, the stock market's on sale. And I think, well, no, it's not. It's the market value because that's what the market says it's worth today. That's not being on sale. And when I try to explain the difference to different types of assets that truly are on sale or can be on sale, they kind of light up when they connect the dots. So real estate. There is a market value for real estate without a doubt. You can go look at real estate, right? And you can determine that the price per square foot on average is $100,000 or $100 or $200 or $500, depending on the market in which you live in. There's a predetermined market, and yes, supply and demand, just like in the stock market, right, buys and sells does dictate price. But what it doesn't take into consideration is that I don't have to pay the same price everybody else does. Yet if I want to go buy Microsoft today, I got to pay the same price you do if you wanted to buy it today yourself. But what if you could go look at real estate and know that maybe it's a distressed seller? Maybe they're trying to offload it because they inherited the property and they don't want it. Maybe it's actually costing them money, right? They're not living there any longer. They moved out and they're still paying a mortgage and property taxes and insurance. And I can come in and say it's worth $200,000, but you know what? I'll give you $175 because I want to take it off your hands quickly. I'm paying less than the average person. That's on sale. Tax liens, tax deeds, these are bid. I can only buy what I bid at better terms, right? So yeah, there's some fair market value, but I'm also able to select those that are going to give me better returns. Non-performing notes, even performing notes, you can go in and buy these at discounts, right? So I can go into knowing that there's a loan that isn't being paid, and we're going to see a lot of that as we go through this economic uncertainty. And you know what? I may be able to wait 6 months for my borrower to get back on their feet and repay. But the person that owns the note today may not afford to carry it any longer. So the $100,000 note, I may be able to buy for $50,000. Because the $50,000 today means more than $100,000 tomorrow to that person. And 6 months from now, I may be able to rework this with my borrower and over time collect $100,000, right? That's an option. Structured settlements is a big one we see, right? Somebody gets into a car accident, they sue Geico, right? The insurance company settles for $300,000 paid out over 10 years. Well, you know what? That person may get a point in their life and they say, I don't want to collect payments every month for the next 3 years. I'd rather have $200,000 cash today. So I can negotiate that and pay them less, right? Because of the time value of money for it today, and then I can collect it over time. And then lastly, private stock and startup companies, right? I mean, how many of you guys would have loved to invest in Amazon while they were still building it in their garage, right? Obviously, we'd be, I don't even know if billionaires anymore. Are they trillionaires yet? I think they're approaching that as their stock continues to climb, but what an awesome opportunity. Now, those are 1 in a million, I suppose, but there's a lot of great companies that I see every day that our clients are investing into that are private. And they're able to negotiate better terms or get better options because they're buying sooner, right? Not necessarily what the public's paying, all at discounts. So we talk about self-direction and assets that we control because we absolutely do. If I want to go buy Amazon today, I got to guess as to whether or not Amazon's going to keep growing their profits. And God only knows what could drop the price or make it go up. But I could go and look at a piece of real estate and know that I could buy that at a discount today, right, if I find the right opportunity. And I also understand that I can generate income off of that investment in the form of rent. So if I can rent it and make money, even if rent is questionable, right, I still have income. If I go buy Amazon, I don't get a dividend. I get nothing. I live and die by the day I buy it and the day I sell it. Yet with real estate and most of these investments, I've got an income stream. Asset value means less to me, yet in the stock market, asset value means everything to me. So I'm not scared to go buy real estate today if the numbers work, because if I can rent it for $1,000 on a $100,000 house, right, and even if I only rent it half the time, that's a 6% return annually. That's a great investment. And if it drops to $60,000 of value, so what? I'm still renting it out. I have no need or desire to sell it because I bought it for the income. But if I buy a stock for $100,000 and it goes to 60, I've got 60. I got nothing to show for it. So my return is based on the return from the day I bought it to the day I sold it divided by the number of years. Whereas my return in real estate or any other investment is my annual return based on actual annual return plus any potential appreciation that I get when I sell it divided by the number of years I held it. That's awesome because I get 2 sets of ways to make money. Knowledge is power, and investing in these asset classes makes tremendous sense if you know what you're doing and you find the right deals. So when we talk about being the banker, the thing that I love, so this is something that's near and dear to me because it's the investment over the last 15 years I've done the most of. I do a lot of private lending. And the first thing people ask when I tell them that I've written loans anywhere from 8 to 15%. And people ask, who's going to pay that kind of interest? Well, guess what? there's lots of loans that are very good deals, but they don't meet the criteria for banks. Remember, banks have to follow a strict and narrow requirement because they want to sell them on the secondary market. So if you're trying to buy a house that's been burnt down, right, and you're going to go put 50 grand into fixing it all up because it's a great buy and with the work you can get a good sale price, a bank's never going to write that loan. But someone will pay me 10% or 12% interest for 6 months, because the amount of interest isn't really that much in the grand scheme of things, and they may buy this property for 20 grand, put 50 into it, they've got 70 and sell it for 150. So they're paying a premium, not because they're bad borrowers, but because their asset class may not meet the criteria. Small company loans, bridge loans, real estate loans, these things all exist for them. I wrote a personal loan a few years back, 11% interest, to someone I knew very well that had very good income, that personally pledged their assets to cover the loan, because they had $40,000 worth of credit card debt at 18 and 20 and 25% interest as stuff got into default. And so they cut their payments almost in half, and I got to make a good return, right? These are loans that exist all the time. You may even know people, right, today. So there's opportunities out there. And if you don't, all the real estate loans I've ever done, I did not originate myself. I've used third parties that help me find them, and they charge a fee, right? And they get to make a little money, and I get to make the interest. So you don't have to be the expert. You just have to go find the people that are the experts. So I can assure you, if I can do these deals, you can do these deals. What I love about loans is you control it all, right? You probably recall the saying, "He who has the gold makes the rules." It's so true. You know what? I have the power to say no. So if somebody says, I want to borrow money and this is what I offer as collateral, if that collateral doesn't seem overly sufficient to cover the value of the loan, guess what my answer is? No, I don't care what the interest rate is. So I don't care if you pay me 15%. If you're giving me an asset that isn't worth the loan amount, it's not a good loan for me. For you, you may be okay with that. If they pay you enough interest, you'll take the risk. That's not risk I want to take. But the beauty is I get to make that choice just like you do. And that's what self-direction offers. So terms, amortization, length of time, prepayment penalties, collateralization, all of those things are all determined, right, by me as the lender. And if the borrower doesn't like it, they can find a different lender. And you'd be amazed if you just say, hey, I appreciate that, but you know what? I don't like to write loans where I don't have enough collateral. And they may go, gosh, I didn't realize that was what was holding us up. What if I offered something else? I have a different house that has equity. Would that work? There's lots of ways to get there, but you get to make all those decisions. Real estate. Oops, excuse me. Real estate is so cool because you can buy any kind of real estate. And I have to tell you, when I first started here, right, 15 years ago, I always thought that real estate was rental real estate that renters trashed, moved out, and then your job was to go in and clean up the carpet, you know, replace everything. Because as a kid, my dad owned a couple rental properties, and guess what? I was the kid that got to go in there and help roll up the urine-infested carpet, and I just assumed they did that all the time. But looking back, my dad had these great properties, and yeah, every now and then he had to go in there and clean up after bad tenants. But there were many, many years of great prosperity with good tenants. And my dad's made a lot of, been able to build a lot of personal wealth, so he's not reliant on his business income. He's able to have passive streams of income. I always thought that was it. I have learned people invest into real estate in so many different ways, right? We have clients that buy raw land that put billboards on it and lease it to the companies that go sell billboards. And they lease their land, and agriculture and, you know, farmland and hunting land, you know, to name some raw land stuff. And then you get into, I've seen clients that have bought 5-bedroom homes and turned them into assisted living facilities and leased them to a company that would manage it. And I've seen people do single family, multifamily, commercial, your traditional stuff, your non-traditional stuff. I've seen people buy land and lease it to people to park cars on it. I mean, you name it, you can do it. And what I love is it's your choice. And I continue to be more and more surprised, impressed, and excited to see our clients go through with some new creative strategy to buy real estate and make money on it. Let me pause there. All right. So I've got some questions. It says, can I print out a copy of this page? And I think I may have, some of these are in chat and some are in Q&A. So can I print out a copy of this page? I'm assuming based on the time that may have been the slide on the account types. We'll send everybody a link to the presentation so you'll have the full deck of slides. As a current W-2 employee with an employee-sponsored 401k, can I change it to a self-directed 401k now? If you are currently employed, generally you cannot move that particular 401k out while you're an active employee. You can call them and ask if there's any provisions. Sometimes if you're over the retirement plan age, you can. If you have other 401ks, old 401ks, previous employers, those are all accessible to you and can be rolled over, but current 401ks cannot. IRAs don't have that restriction because they're not employer sponsored. Can you discuss comparative expenses from traditional 401k expenses versus custodial self-directed IRA costs? Briefly, so when it comes to costs, there's a few different ways that institutions make money. So in 401ks, there's typically a few different sets of fees, and it depends. Some employers bear some of this cost, some of it's divided up and passed on to the individual accounts, and I can't speak to that. But typically inside a 401k, the first cost is the plan itself and the overall record-keeping, administration, and operation. So at NewView, we bear that cost. We pay that 100%, so our employees don't pay a penny of that. So like I said, I can't speak for your company, but we cover that, but that's one potential cost. The second is most 401k plans are designed to only hold a certain amount of assets, right? 7, 8, 10 mutual funds, a large cap, a small cap, where the real costs associated with that are the loads inside each of those funds. You can request a prospectus on any of those plans, and you can see in there what their ratio is on what they're charging. Those are fees. The second or the third fee is if there's a management. So if there's someone that's physically managing like an advisory role over that 401k, they too may have a fee. That could be paid by the employer. It could be taken out of each respective account as a prorated percentage. So in a self-directed account, we charge custodial fees. So if you want to make an investment with us, you want to buy a house, we charge you $95, right? So we don't charge a percentage. There's no piece of the price of the property that we're calculating. We just charge you a flat $95 fee, and we go execute that purchase for you. Annually, you can either pay us based on the value of your account. So plug in the value of your account. It'll spit out a fee. That's our fee. There's nothing else there. The second thing is you can pay us per asset at $295. So one house, $295. So you could take $200,000, buy a house, and pay us $295. That's just over 0.1%, right? Our fees are insignificant in most cases, but the smaller the account, the more our fees are because the cost for us to buy a house is the same whether you buy a $5,000 or $500,000 house. Presentations on solo 401k, yes. We do host them. We have some posted into the blog section now, but we typically do that once a quarter, if you will, but you can visit that on the website. The next question says, are you saying one can hold real estate in a Roth IRA and save on taxes? What is self-directed account is best? Hold an LLC real estate. So yes, if you have a Roth IRA, and you buy a piece of real estate in that Roth IRA or invest into an LLC that buys the real estate, because there was an LLC question there, all of the gains on that real estate are 100% tax-free. Right? So yes, what you're asking is absolutely the case, and it may sound too good to be true, but that's the beauty of Roths. As far as to open a Roth, it says independent contractor, to use the total earned income from 1099, or does it need to be subject to subtract expenses and the net deposit up to $7K. So I won't get too deep in the weeds. I'm not an accountant. Generally, you have to have earned income. So it would depend on 1099 doesn't necessarily equate to earned income. It depends on how you translate that on your taxes. My general understanding is whatever amount you pay self-employment tax on or FICA tax on is considered earned income, right? So it may net out. Again, it depends on how you take your money. With entities, people can withdraw money out as profits and dividends, and that may not constitute it, whereas it doesn't have to be W-2, but it has to be self-employed. So that's an accountant level question if you do want to go further with that. Keep the questions coming. We're only got a slide or two left. Let me get back to, I'm new to all of this. Are the accounts FDIC insured or some other protection against fraud or theft? So with our accounts at NewView, we only hold cash instruments in FDIC insured investments or vehicles, which is a positive. There's no risk of loss of the funds. We are not a bank, so we are non-depository. We hold our money in banks, right? So as a public trust company, it is different than a bank. Self-directed custodians are not banks. They don't deposit your own money. We use banks to deposit your own money, and applicable FDIC insurance and other things would be a pass-through to you as an account holder. As far as investment, as far as when you make investments, there is no insurance beyond casualty or liability stuff on your property, and that's because there is no way to insure a loan or any other type of investment from that standpoint. All right, kind of follow on that, it says, I've read bad reviews from other self-directed IRA companies, which turned me off. One of my biggest concerns is the access to accounts by the beneficiaries. Can you touch on the process my beneficiaries would need to go through should something happen to me? So, you know, the hardest thing in the self-directed IRA world is it's a big market, and there's a good amount of companies that do this, and there's some that are super big and some that are mid-sized and some that are super small. And the reviews vary, and they're like hotel reviews. You should probably discard a few of them, right? Some people you'll never make happy, but if every review is bad, it generally gives you an idea that maybe the company's missing the mark. As far as the way that beneficiaries work, when you open your account, you designate death beneficiaries. So upon your passing, if you have two beneficiaries, let's just say two kids, either one of those kids would notify us. Obviously, we wouldn't know unless someone told us. We would request a death certificate. They would fill out, they have a couple options. This is IRA specific, not NewView specific. They can take that account, I believe it's up to 10 years. There's been some tax law changes on it. They can take it as a lump sum, or they can move it into their own account and take it over a 10-year period. If they choose that 10-year period, they would open up accounts with us. We would divide the assets based on the proration you designated when you set up the account. If it was 50-50, we'd split it, and then each of them would operate that account and would draw from it as required up to that 10-year period. Right? And we can talk more about that, but the process of beneficiaries works the same way here as it does at Schwab. The only thing we talk to our clients about is, at Schwab, it's easy to liquidate a security. Here, if they own a piece of real estate, they may not be able to liquidate it immediately. So we're big believers in education, and if you're going to designate your kids as beneficiaries, you may want to talk to them about, hey, this account owns some different assets. Here are some things that you can do to know maybe what to do. And so rather than just fire selling it, you may want to learn a little bit. And so that's just education on good financial prudence that you can pass on to your kids. So I've got, I think, 2 slides left, and I'll wrap up with any questions that we may have. So what we do is provide the administration, the custody, right? We execute contracts, purchase agreements, et cetera, on your behalf. The custodian is by default the signatory, so whether that's Schwab or us, we are the signatory on your behalf. We deliver all the IRS mandatory filings, so we do that on behalf of the IRA just like Charles Schwab does. And then we pay income and expenses, collect income and dividends based on your direction and guidance. So you want us to pay the plumber, we'll pay the plumber. You can go right onto our website. You have a bill pay function like you would at Bank of America. You plug in who you want to pay, how much you want to pay, frequency of payment, and we'll pay them on your behalf. Income comes right into us. We deposit it. You'll receive a notification. You can log into your account, just like at Bank of America, and see all that activity on a regular basis as well. So waiting means, there's a quote that says, doing nothing is a decision. And right now, there's a lot of people that are doing nothing. But just know that's a decision. And that may not be a bad decision if you're just waiting to see how this plays out. But if you're doing nothing because it's easier to do nothing than it is to do something, you may be missing out on opportunity. So you're continuing to be exposed to market volatility if that's where all your funds are, right? The ups, the downs, and maybe you're the blackjack player that likes that, which is great. If you're not, probably time to make a change. You're continuing to pay retail price. Remember, you're paying whatever every other investor pays if they buy it at the same time. Alternatives are the only asset classes that allow you to buy below what the market would pay as a general rule. So there's lots of opportunities that exist. The longer you wait, the more you may be missing out on. So how does it work? What are we doing next? Talk to our team. We're not advisors, right? But we do consultations with our customers. We're smart about self-directed accounts. We have experience. Rely on that. I encourage everyone, pick up the phone and call our team. Ask some questions. One, it'll give you a taste of the type of team that we are, our accessibility. But we recognize it's personal to you. You don't know, I covered an hour of a variety of things, and what you're asking and wondering may be slightly more deliberate or specific. So take advantage of that. We can walk you through the process if you choose to move forward to get your account set up. And then the key is go make your investments, because sitting on the sidelines is a way to miss opportunity, unless you're sitting on the sidelines waiting for opportunity. Either way, get your account set up and get yourself ready for that. Last thing here, and I think it's the last slide, right? Yeah, second to last slide. So if you don't have our e-guide, it's something that we offer. You can text your first and last name to 484848. It is going to ask you for some of your information. Don't worry, we already have it, so you're not giving us any info we don't already have that you didn't use when you registered. But it will give you the e-guides. I know, some people learn better by watching and listening, and some people learn better by simply reading. So it gives a little more in-depth into each plan type, and we'll talk a little bit more than we discussed in a more deliberate fashion. So take full advantage of that. We will wrap up now. If you've got any further Q&A, now is the time to ask them before we close down. It says, can a self-directed IRA lender make a borrower buy PMI for a loan like a bank might? My understanding is yes. They would have, how they find the insurer, but sure. I don't know of anything that would keep that from happening. There's no, as long as unless the insurer didn't like the lender being an IRA. I've never heard that, but I've also never had a question asked about PMI. But my understanding, just from the lending side personally, is that it's permissible. There's no issue with it, and you most certainly could reach out to a couple of these insurance providers and see if they will do that. It's brilliant, actually. I've never thought about that, so thank you for the question personally. Yeah, as far as everything that I would know and understand about it, other than maybe the issues of finding someone willing to do it, you certainly can do that. So great question. I will check one other spot to see if we got any other questions. Otherwise, we'll get wrapped up here. I don't see anything else that's come in through the chat. So I guess at this point, since I've got no additional questions, I will thank you all very much for joining us. I would encourage you through this process, number one, to be safe, right? Stay healthy, that's important. Secondly is determine where and what you think the future looks like. And I know we're not psychic and we don't have crystal balls, but if you think there's going to be continued prolonged economic uncertainty, the stock market may not be your best friend in a time like that, right? So if you're looking to put your money into something that gives you a little bit more control, or you're looking to put it into a place where you can park it and then make that investment, we can help you with that. Something that I'll wrap up with is we are currently running a summer promotion. I believe it expires at the end of May. The promo code is SUMMER, but what it does is it waives all the fees until your first investment. So normally there's a small quarterly fee to have your account open, until you make an investment. It's waived. So is the $50 account opening fee. So if you're kind of sitting there saying, I don't know if I know I don't want to be in the market long term, it's just a scary place for me, things have gotten close enough to back to normal that I want to take the money off the table and run. If you want to run to Newview and we can be your safe haven to tee yourself up for opportunity, we can hold that account completely free of charge until you make your first investment. So if that happens a week from now, awesome. If it happens 6 months from now, when the opportunity strikes, great. But take full advantage of that. I believe that's only running until the end of the month. And you can talk to our folks on the team about that promo code, but it is promo code SUMMER. And we typically do maybe one promo code a year, two at most. So thank you guys so much. Stay safe. And if there's anything we can do to help you on your journey of self-directed investing, we look forward to the opportunity, and keep an eye on our emails and our website. We're continuing to dial up our educational content. Look forward to having you at future webinars and events. So thanks, everybody, and take care.